Time value of money basically depends upon what you can earn on your dollar today. So, in other words, a dollar today is worth more than a dollar tomorrow. Or, what do you think is better? 250,000 today or 250,000 in 5 years time? That's what the present value is. So calculating present value means that finding the worth of a future cash flow as of today. So what would be the value of 250,000 that I have today in 5 years time? So that's what we are trying to do. So we're trying to figure out a value of the money that I'm going to get in 5 years time today. So and the way that works is that it gets discounted back. But let's keep going, and I'll explain it to you in the easiest possible way as possible there is out there. So I've tried to, when I was trying to get my head around all these things, and when I started off almost 5 years ago, it took me a while to understand how these concepts come together and how they actually work. And although I had studied them in school and everything, and then I'd forgotten everything because you don't do them, but when I got into property development, this was something that was very very important, and you must understand what this actually means. So suppose you have $100 today, and you can either consume it or save it for future consumption. And when you choose to save it for future consumption, you will deposit that in a bank, and the bank will be paying you some sort of an interest on it. And assume that the bank is paying you 5% interest annually, and you will be withdrawing the interest payouts. So as the bank starts paying you the interest, you'll start withdrawing them. So if you look at what the cash flow would look like in this scenario, it would be whatever the amount that you deposit, let's say is $100 at 5% interest, and you've got in the first year $100. That means you were out of pocket $100 because that went into the bank, and then the interest payout for the first year was nothing because you're still accruing interest on it. And at the end of year one, you got back the $5 that you had put in, and you got back your principal. So if you look at your entire cash flow, it will look like you were out of pocket $100 for the first year because you deposited that money. That money went to make money somewhere else. So that money went out of your pocket. But at the end of the year, you got back $105. So what does that actually mean? So what it means is that when you deposit that $100 and after 1 year you got back $100, what it means that $105 next year is actually worth $100 right now, today. So that's what it actually telling you, that $105 that you'll get in a year's time is only worth $100 today because it can enjoy 5% interest sitting somewhere else in the bank. And that's what the opportunity cost of that money is. So that if I was to and I'll see, the way this translates into you making a decision is that if you put in X amount of money in this project and the return that comes back to you, what is it worth? And if you were to put the same amount of money in another project, and what would that return would be to you on the other project? So you have to compare them, and you can accurately compare them only when you've got you take out a present value based on the timelines and on different projects, and it starts getting a little bit complex. But anywhere we do all of these things, and I'll quickly refer back to where these things matter in the feasibility, so that you understand and link and are able to link what the theory is and what the feasibility application is actually doing for you. So so in the present value, when you're trying to do that, there's a thing called discount rate. Discount rate is nothing but the interest rate we use here is to calculate the present value. In the present value calculation is called the discount rate. And the discount rate is a rate at which we discount the future cash flows to find present value. And it can be your cost of capital, it can be your cost of equity, your desired rate of return, or a hurdle rate, or even the interest rate a central bank charges depository institutions. So in essence, don't get confused by all this jargon, because all it is that it is an opportunity cost of the money. It is where what else could your same money do elsewhere, and at what other return can it actually make? So when you go into the feasibility application here, so if you go into your dashboard, this is where we actually put our hurdle rates. And as we go in there, I'll explain what net present value is and what sort of hurdle rate we're going to use. So this is available in both the international version as well as the Australian version, and we can set up and put a hurdle rate. So that means that if I was to put in $500,000 in a project, what hurdle rate is this? Can I make the same amount of money somewhere else, or can I make at least a 10% interest on my money somewhere else? And that's the hurdle rate, because that is the opportunity cost of the same money of me putting my money into this project and what it would do for me if it was elsewhere making 10%. So that's what that hurdle rate is all about. So let's go back into the slideshow. And alternative to the direct capitalization method of valuation, it calculates the present value of expected future project cash flows to determine or estimate the current value of the project. So that's where we use it. We actually use this discount rate in the discounted cash flow method. And where would you find all of that? So if you go into your budget sheet, after you've done your calculations, after you've clicked on your add-on and clicked on update values, you'll see that this section here will get populated. This is where your NPV is. It's telling you that this is 10%. This is your hurdle rate referring back into your sheet, and you'll be able to calculate what your levered free cash flow would be, what your developer cash flow on the equity NPV, which is your net present value. That is what we're trying to figure out in this project would be, and then your internal rate of returns would be. And we'll get into the internal rate of returns very soon. So that's what that hurdle rate is for. And that's what we are trying to do here, is we're trying to discount all these future cash flows that will occur during the life of the projects, where the money is going to keep going out of our pocket, and in the end it's going to be a big cash windfall when all the properties are sold or leased or disposed of in some matter. So whenever the inflow happens, it discounts it back to 10%, and then gives you a value of what your future of what that money should be worth in today's time. So let's keep going with this. So instead of dividing the net operating income or profits by a cap rate, this method discounts future cash flows at the investor's required rate of return to take into account the time value of money across the expected project timeline. So let me go back into this sheet over here. It says the reason I'm going to and fro with all the theory that we need to understand is so that you can actually relate this to the theory that I'm talking about here. We will start from scratch, and I will go through every module in detail so you know how to actually input these values and make sense. But for the time being, I just want you to understand what they are and what everything is related. So up top over here, we've got this timeline over here. This is all done monthly. Because in this scenario, whenever we are doing a feasibility on a development, they are usually done in on a monthly basis, because all the cash inflows and outflows would happen on a month-by-month basis. So that's the timeline. And if you go back here, so instead of dividing the net operating income, so you can actually value the property by dividing it by cap rate, but discounted cash flow method doesn't do that. It actually discounts the future cash flows at investors' required rate of return. And if I just go back in here, this is what I was talking about, that what is the discount rate? So discount rate is nothing but a cost of capital. So if your money is sitting somewhere else making money, that's what it is: cost of equity, or desired rate of return, or a hurdle rate. So this section here is your discount rate that we are putting in against the net present value. So we can discount these cash flows to 10%. And get a value there. So across the timeline. So that's what this is about. So this is the discounted cash flow analysis. It prefers near-term cash flows. So basically, in the sense that it's talking about cash flows that are going to happen in a shorter amount of time rather than in a very long-term process. So discounted cash flow, for example, if the project was to spend 10 years or something, discounted cash flow wouldn't actually, this analysis wouldn't actually give it more preference. So it gives more preference if the projects are turned over in the next 24 months or 48 months and so on. So what questions does it actually answers for us? So how many dollars go into the investment? When do the dollars go into the investment? How many dollars come out of the investment? And when do they actually come out of the investment? So these are the questions that a discounted cash flow would answer for you. So if you look at in any of the feasibilities, whether it's international or Australian, wherever there is a difference, I'll actually mark out and point out so that it's easier for everybody to understand. But apart from that, everything is more or less the same. So it's telling you when is the money going out. So everything in a bracket is like a negative section here that talks about that this is the time that the money is actually going out of your pocket. And in month number 30, 31, and 32, that's when your sales start to happen. That's when the money will start coming out. How much is it going out every month? And how long is it going to go out for? And when it'll start coming back in, and what will come back in. That's what a discounted cash flow actually tells you, and that's what that is. So this is a simple example that we are continuing from there. So let's say end of year. This is an yearly example, but our feasibilities are done on monthly example. There's no difference. The only difference is that the timeline over here is in months, and the timeline here in this example is in years. So end of year, we've got 0, 1, 2, 3, 4, 5. You've got cash flow before tax, and then you've got cash flow before tax plus sales proceed before tax, because you can use this method to actually do a feasibility on an investment property as well. So you've got holding period, which is the end of the year, initial investment less acquisition costs. Then you got annual cash flows, which is cash flow before tax is equal to gross income less expenses plus debt service. So that's what this is. So to sum it all up, discounted cash flow analysis is a technique used in finance and real estate to discount future cash flows back to the present. There are 3 different steps to it. Forecast the expected future cash flows, establish the required total return, and discount the cash flows back to the present value at the required rate of return.